But the big sector that's moving today is some of those capital market plays. You have Surabhi who's joining in to tell us about SEBI overhauling some of the MF regulations. Surabhi, over to you.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or their cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
Take that point, Surabhi. Thanks a lot for that. So all the fact that, there has been considerable middle ground which has been achieved by the SEBI has the street relieved, and we've seen a big spike in a lot of these capital market plays as well.